The yield curve measures the difference between long-term and short-term government bond yields, like the 10-year and the 2-year Treasury. Normally, the curve is positive. You get paid more for locking your money up longer. This reflects expectations of a healthy, growing economy. Inversion is when short-term yields become higher than long-term yields. It's a warning sign, usually the result of the Federal Reserve hiking short-term rates to fight inflation, which makes borrowing money expensive and chokes off economic activity. Steepening, which is what's happening now, occurs as the curve comes out of that inversion. Historically, this is the final danger signal. It happens when the Fed starts cutting rates because it sees the economy weakening. And that's exactly what happened. The Fed cut rates 3 times in late 2024, causing short-term yields to fall faster than long-term ones. That's what pushed the curve out of inversion to its current level of around 0.5%. Historically, the recession begins when this spread is between 0.1% and 1%, putting us squarely in that critical zone. Other indicators are also pointing to weakness. The Conference Board's leading economic index fell again in June. This important metric provides an early warning sign for big shifts in the business cycle. The manufacturing PMI has also been in contraction territory for months. This index measures the health of the manufacturing sector. Readings above 50 indicate expansion, and below 50 signal contraction. The PMI has dipped into contraction territory several times over the past 2 decades, often around periods of economic slowdown. Right now, it's sitting at 48, indicating a contraction. So if all these indicators are pointing in the same direction, why isn't the economy falling apart? The key difference this time around appears to be the US job market. When the curve first inverted back in 2022, the labor market was on fire. Job openings were higher than anything we'd seen in over 20 years, creating a massive economic buffer. Compare that to 2007 or 2001 when the labor market was much weaker. Back then, an inverted yield curve was enough to push a fragile job market over the edge. Today, things have cooled off. Job openings are down about 30% from their peak. The economy is more vulnerable than it was, but it's still stronger than it was before the pandemic. This unique situation, a classic yield curve signal, clashing with a historically resilient labor market, creates a great deal of uncertainty.